Value versus growth investor. Investing in stocks can be approached in many ways, and two common strategies used by investors are value investing and growth investing. The differences between the two approaches can be seen in their goals, methods, and criteria for selecting stocks. Both strategies have advantages and disadvantages, and successful investors tend to use a combination of both approaches depending on market conditions and their investment objectives. Value investing is a strategy where an investor looks for stocks that are undervalued by the market. The goal is to buy stocks at a discount and hold them until the market recognizes their true value, which would result in a higher stock price. Value investors focus on a company's financial fundamentals such as earnings, cash flows, and book value. They look for stocks that are trading at a lower price than their intrinsic value, which is determined by analyzing the company's financial statements and other relevant information. Value investors use different methods to determine the intrinsic value of a company's stock. One of the most popular methods is the price-to-earnings ratio, PE ratio, which compares a company's stock price to its earnings per share. A lower PE ratio suggests that the stock is undervalued compared to its peers. Another method is the discounted cash flow, DCF, analysis, which calculates the present value of a company's future cash flows. If the present value is higher than the current stock price, the stock may be undervalued. Value investors also look for companies with strong balance sheets, low debt levels, and consistent earnings growth. They typically invest in mature companies that have a long history of profitability and a sustainable competitive advantage. These companies tend to pay dividends, which provide a steady income stream for investors. Growth investing is a strategy where an investor looks for stocks of companies that are expected to grow at a faster rate than the market. The goal is to buy stocks with high growth potential and hold them for the long term, allowing the investor to benefit from the company's future earnings growth. Growth investors focus on a company's growth prospects, including revenue growth, earnings growth, and market share. Growth investors typically invest in companies that are in their early stages of development and have high growth potential. These companies may not be profitable yet, but they have innovative products or services that have the potential to disrupt their industry. Growth investors are willing to pay a premium for these companies' stocks because they believe that the company's future earnings growth will justify the high price. Growth investors use different methods to identify companies with high growth potential. One of the most popular methods is the price-to-sales ratio, PS ratio, which compares a company's stock price to its revenue per share. A lower PS ratio suggests that the stock is undervalued compared to its peers. Another method is the earnings per share, EPS, growth rate, which measures the percentage increase in a company's earnings over a period of time. Companies with high EPS growth rates are often considered to have high growth potential. Growth investors also look for companies with a sustainable competitive advantage, a strong management team, and a large addressable market. They typically invest in companies that are leading their industry or have the potential to do so in the future. These companies may reinvest their earnings back into the business instead of paying dividends, which can result in a higher stock price over time. Value investing and growth investing are two different strategies that investors use to approach the stock market. Value investors look for undervalued stocks based on a company's financial fundamentals, while growth investors look for stocks of companies that are expected to grow at a faster rate than the market. Both strategies have their advantages and disadvantages, and successful investors tend to use a combination of both approaches depending on market conditions and their investment objectives. The benefits of value investing include the potential for high returns, a focus on financial fundamentals, and a long-term strategy. The benefits of growth investing include the potential for high returns, a focus on growth prospects, and a long-term strategy. Ultimately, the best strategy for an investor depends on their investment objectives, risk tolerance, and market conditions. By understanding the differences between value investing and growth investing, investors can make informed decisions when investing in the stock market. Use code BLOG to receive 25% on your next purchase. Thanks for watching.